Meet John and Paul. They're both 28 years old. Both have stable full-time jobs. They both earn $65,000 a year. For years, they've lived below their means, skipping expensive vacations, driving used cars, saving every extra dollar they could. And over time, they've each managed to save $50,000. For both of them, it's the biggest financial milestone of their lives. John has always believed real estate is the best way to build wealth. He likes the idea of owning something tangible. Paul sees things differently. He believes the best investment is the one that quietly grows in the background, without demanding his time. So today, we're not comparing every dollar John and Paul invest. We're comparing two very different strategies for building wealth. Let's follow their journey over the next 20 years because the outcome is nothing like most people expect. Let's begin. John decides to use his $50,000 as a 20% down payment on a $250,000 rental home. It's nothing luxurious, just a well-maintained house in a decent neighborhood. After researching the local market and comparing several properties, he's confident he's found one with strong rental potential. To finance the purchase, he takes out a 30-year mortgage at a 7% interest rate. His monthly mortgage payment comes to about $1,330. And fortunately for John, just a few weeks after purchasing the property, he finds a tenant willing to pay $1,800 a month. The numbers look fantastic. Each month, John collects $1,800 in rent. After making the mortgage payment, it looks like he has roughly $470 left over. It almost feels too easy. Paul takes a completely different route. Instead of buying property, he invests the same $50,000 into a total stock market index fund. No leverage, no tenants, no repairs. After covering all his living expenses and setting money aside for emergencies, Paul still has about $200 left over each month. So, he sets up an automatic investment of $200 every month. Once everything is in place, he closes the app and gets on with his life. Paul's investment doesn't feel exciting. There's nothing to visit, nothing to collect rent from, nothing to proudly show his friends, just a number quietly growing inside an app on his phone. On day one, John looks like the obvious winner. He owns a house. He has a tenant. He feels like someone who's building real wealth. Paul has nothing more than a brokerage account and a confirmation email. One investment feels real. The other feels invisible. But investing isn't about what feels impressive. It's about what actually builds wealth. During the first few years, everything seems to be going John's way. The rent arrives at the beginning of every month. Every mortgage payment chips away at the loan. He drives past the property after work and quietly smiles. I own that. The house slowly increases in value. Each mortgage payment builds a little more equity. Everything about the investment reinforces the feeling that he made the right decision. Paul has a very different experience. Every few months he logs into his investment account. Sometimes the balance is higher, sometimes it's lower. Most of the time it doesn't feel like much is happening. The gains seem small. The excitement is almost non-existent. There's no tenant thanking him. No building he can point to. No physical reminder that his money is working, just numbers quietly changing on a screen. John's friends constantly ask about the rental property. Paul's friends rarely ask about his investments. From the outside, John looks like the successful investor. Paul just looks patient. 3 years pass. Now, let's compare where they actually stand. Over those 3 years, John collects roughly $64,800 in rent. His mortgage payments total approximately $47,880. On paper, that's nearly $17,000 in positive cash flow. But there's one small problem. That number only exists on paper because the moment you own a rental property, the bills begin to arrive. Property taxes, insurance, routine maintenance, a month without a tenant, advertising the property. Individually, none of these expenses seem overwhelming. But together they quietly eat away at what once looked like easy profit. Then there's John's time. To save money, he manages the property himself. That means late-night phone calls from tenants, weekend property inspections, meeting contractors, scheduling repairs during his lunch breaks. By the end of those 3 years, That $17,000 he thought he'd made has shrunk dramatically. After accounting for every genuine expense, John has realistically kept only a few thousand. And even then, his own time still hasn't been factored into the equation. Paul, meanwhile, has experienced something far less dramatic. His original $50,000 investment has continued growing. He's added another $200 every month without interruption. Assuming the market delivers its long-term average return of around 10% annually, his portfolio has grown to roughly $76,000. He hasn't answered a single phone call from a tenant. He hasn't repaired anything. His money has simply continued working quietly in the background. But John still has one enormous advantage: leverage. His rental property was purchased for $250,000. After 3 years, the property's value has climbed to somewhere between $275,000 and $280,000, depending on how strong the local housing market has been. Meanwhile, every mortgage payment has reduced the amount he owes. His equity has climbed to somewhere around $80,000 to $85,000. That's genuine wealth. And a large part of it came from controlling a $4 million asset with only $50,000 of his own money. That's the unique power of real estate. It's also something stock investors can't easily replicate. And it's one of the biggest reasons property investing has built so many fortunes over the decades. But here's the part nobody talks about. The rent check makes rental property look like easy money. But rent isn't profit. It's only where the story begins. Because before that money reaches your pocket, every rental property comes with a long list of expenses. First, there's vacancy. No rental stays occupied forever. Even a great property will eventually sit empty between tenants. A good rule of thumb is to budget for around 1 month of vacancy every year. That is 1 month with no rent coming in while the mortgage still has to be paid. And when a tenant leaves, another set of expenses begins. Cleaning, fresh paint, minor repairs, advertising the property, screening new tenants. Every turnover quietly eats into your returns. Then there's ongoing maintenance. A rental home is a physical asset, and physical assets wear out. A leaking faucet, a broken appliance, an air conditioner that suddenly stops working. A common rule is to budget around 1 to 2% of the property's value every year for maintenance. On a $250,000 house, that's roughly $2,500 to $5,000 annually. Some years, you'll spend far less. Other years, much more. Then come the big-ticket repairs. Roofs, water heaters, furnaces. These aren't unexpected. They're inevitable. The only question is when they'll happen, and when they do, the bill often runs into thousands of dollars. One repair can wipe out months of rental profit. Finally, there's the cost of managing the property. Hire a property manager and expect to pay around 8 to 10% of your monthly rent. Manage it yourself and you're trading money for time. Either way, someone pays. That's why experienced investors never calculate rental profit using just one equation. Rent minus mortgage is only the beginning. The real numbers don't appear until every hidden cost has been included. And that's exactly what John experiences. Month after month, year after year, the expenses slowly begin to add up. 5 years later, John is no longer the excited first-time landlord. He's become an experienced one. He's already rented the house to 3 different tenants. The roof eventually needed replacing. A plumbing emergency appeared out of nowhere. The property sat empty between tenants more than once. Fortunately, rent has increased to around $1,950 per month, but so have property taxes. Insurance premiums have climbed. Maintenance costs continue to rise. After adding everything together, John's actual cash-on-cash return settles somewhere around 3 to 5%. Still respectable, just nowhere near the 15 to 20% many people casually claim online. Paul's investment journey looks almost boring by comparison. Nothing dramatic has happened. He hasn't switched strategies. He hasn't chased hot stocks. He hasn't tried to predict recessions. Every month, another $200 automatically goes into his index fund. That's it. By year 7, his portfolio has grown to roughly $120,000. And something important is beginning to happen. His investments are now generating more growth each year than many of his annual contributions. This is where compounding quietly changes gears. The first few years barely feel rewarding. Then the gains begin producing their own gains. And every year after that, the curve becomes steeper. Underneath the surface, both investors are building wealth, just in very different ways. John's wealth depends on leverage, appreciation, rental income, and active management. Paul's wealth depends almost entirely on time. One requires continual involvement. The other requires continual patience. By year 10, the comparison becomes much more interesting. John's rental property is now worth somewhere between $335,000 and $370,000, depending on how the local housing market has performed. His remaining mortgage balance has fallen to roughly $172,000. That gives him approximately $165,000 to $200,000 in equity. Not bad at all. But building that equity hasn't been free. Over the past 10 years, John has spent roughly $30,000 on property taxes, insurance, maintenance, repairs, and vacancy costs. Paul's portfolio tells a different story. His original $50,000 investment combined with 10 years of steady monthly contributions has grown to approximately $170,000 to $180,000. Over that decade, he's personally invested around $74,000. Everything above that has come from market growth alone. No leverage, no tenants. At this point, something surprising happens. Their total wealth is remarkably close. Depending on appreciation, John may even be slightly ahead, thanks largely to leverage. But numbers alone don't tell the whole story. John reached this point while carrying hundreds of thousands of dollars in debt. His entire investment is tied to a single property in a single neighborhood. He spent hundreds of hours managing it. Paul owns tiny pieces of thousands of companies spread across the economy. His investment can be sold almost instantly. And outside of making one automatic contribution each month, it has demanded almost nothing from him. By year 10, neither investor has clearly won. They've simply taken two very different paths toward almost the same destination. Another 10 years pass. Now we're looking at the full 20-year picture. John's property has continued appreciating over time. Depending on the local market, it's now worth somewhere around $500,000. His mortgage balance has fallen substantially. After 2 decades of ownership, he's built approximately $385,000 in equity. Throughout those 20 years, the property has continued generating rental income, but it has also continued generating expenses. When every dollar is counted, John has generated roughly $120,000 in net cash flow from the property after all expenses. Some investors will do much better, others will do much worse. Real estate depends heavily on the market you buy in, the tenants you attract, and how well you manage the property. Paul has experienced a very different 20 years. His original $50,000 investment has quietly continued compounding. Every month, another $200 has been invested automatically. Nothing exciting, just consistency. Assuming the market delivers its long-term average return of around 10% per year, his portfolio has grown to approximately $518,000. Over those 20 years, Paul has personally contributed $98,000. The remaining more than $420,000 came purely from compound growth. No debt, no tenants, no repair bills. When you compare their net worth after 20 years, the result surprises most people. John finishes with approximately $55,000 in total wealth. Paul finishes with approximately $518,000. Two completely different paths, almost the same destination. Yet, the journey couldn't have been more different. John built his wealth through leverage. Paul built his through compounding. John accepted concentration risk. Paul accepted market volatility. John invested time alongside his money. Paul invested patience. Neither approach is automatically better. They're simply different. At this point, it might sound like the stock market is the obvious choice, but that wouldn't be a fair conclusion either. Stocks come with risks that are every bit as real. They're just easier to ignore. Market crashes can be brutal. In 2008, broad stock indexes fell by nearly 40%. During the early months of 2020, they plunged by more than 30% in just a matter of weeks. Imagine opening your investment account and watching years of savings disappear almost overnight. That can be psychologically devastating. Stocks also don't produce meaningful monthly income for most investors. Yes, index funds pay dividends, but the yield is relatively small. A portfolio worth $150,000 might generate only around $250 per month. Useful, but nowhere near enough to replace a full-time income. Leverage is another major difference. Paul used $50,000 to buy $50,000 worth of investments. John used the same $50,000 to control a $250,000 property. When property prices rise, that leverage magnifies the gains. The stock market simply can't replicate that. So, which investment actually wins? That's the wrong question. John believed buying property was the proven path to wealth. Paul believed the stock market would quietly do all the work. Both were only partially right. The real winner wasn't determined by the investment. It was determined by understanding everything that came with it. The money, the time, the stress, the risk, and the opportunity cost. The truth is, there isn't one perfect investment. Only the one that's right for your goals, your temperament, and the life you want to build. So, the next time someone tells you that real estate always beats the stock market or the stock market always beats real estate, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that truly matters.